You're welcome to this course, Malaysian SNR. This is the module 1 of the course. Under this module, we're going to talk about the module 1. We're going to talk about the price action. Then the sub-content is OHLS mechanism, support and resistance levels, price rejection, and manipulation stuff. Yeah. So this is the introductory part of the course. So pay attention. Sit tight. Relax your mind. Open up your mind, your heart to this new concept. Yeah. I wish I've learned this thing for the past 23 years of my trading experience. But we thank God, all is not lost yet. Yeah. 23 years. Now we thank God. So let's go straight to the course. You're going to open your mind into a new concept of trading the support and resistance level. You know, the conventional way of trading the support and resistance levels has been, trading the high and the low, which we assume support and resistance is all about the high and the low. So, but that has been an assumption. That has been a wrong. I would say it's a wrong assumption. Yeah, it's a wrong assumption. Yeah, there lies liquidity above the highs and below the lows of the market. But at the same time, the open and close level of the price plays more significance than the high and low. Yeah, it plays more significant. You will get to know. You will get to understand. You will get to agree with me when we move forward. Now let's go. What is price action? Price action is simply the movement of supply and demand along the price time charts. The price time chart along the price time chart, the movement of supply and demand in a layman language along the price chart, price time chart. So where I put that way is this, because if this is your chart, right? This is your chart, like we have here. This is the time axis, then the price axis. You have the price axis of the chart, then the time axis of the chart. Time. Then we have the price. Sorry. This is the price axis. Why this is the chart, the time axis of the chart. Yeah. Of the chart. So if this is your chart, then that means price action is all about what? It's all about supply and demand forces moving along the price time chart. Yeah, if it happens to be demand, demand is when buyers are exceeding the numbers of sellers in the market, moving up and up along the price time chart. So that is the demand. Sorry, that is for buying, or demand for demand for pulling for the buying upward, right? Why for sellers, so that means the falling down of market prices along the charts. What we mean by selling. So this is buying, this is selling. Selling is price falling below the demand level, while buying is rising above the supply level. Yeah. Then we have the other trend, like the sideways, which is the normal range. We call range. Range. This is range. This is range. That's range. So this is price action. So that means buyers moving along the high, low, high, low, high, low, high, low, high, low, high, low, upward and upward direction. While the selling is about sellers moving along the lower high, lower low, lower high, lower low, lower high, lower low along the price. Then the sideways trend is when we have the equal highs and equal low. Right. So that is about the meaning of price action. Meaning of price action. Price action follows the principle of the principle of what? The principle of market price moving up or moving down or sideways. Three trends. Follow three trends. It's either price is moving higher or it's moving lower, or it will be moving in a bracket form. Moving in a bracket form. So having get that experience, you likely go to that is the technicality behind the price action. Now, how do we chart what is being represented? How does this information represent? How does it represent in our trade charts? How does it represent in our trade charts? How does it represent our trade charts? So we have two types of in technical analysis. We have two types of charts. We have the line charts. Then we have the candlestick. This is the candlestick chart. Then we have the line charts, which is this, the line chart and the candlestick chart. So the candlestick chart represents four informations, pattern information, which is the open, high, low, close. While the line chart only displays the body in relative to the close. It only displays the body in relative to the close. The body relative to the close. So that is the two charts we have in the market. How does price represent this information in a chart form? So we go straight to the OHLC mechanism, which is the open, high, low, close. What is OHLC? OHLC is simply open. OHLC is simply open. Open this way. O for open, YH, H for high, then L for low, C for close. So that is the meaning of OHLC. OHLC, open, high, low, close. So that's the three four information, pattern information that's represented by candlestick in the chart. Yeah, so that means we have here, if this is a candlestick, if this is a daily candlestick, it displays the opening price, the highest price, the lowest price, and the closing price for the for that particular session. So it could be daily, it could be 4 hours, it could be 15 minutes, it could be any time frame you choose. So it will display the price information in this form. This is the, that means this is the open, this is the open, it closes lower. Then if for buyers, it opens below and closes higher. And let me repeat again. For seller, it opens above and closes lower. That is for sellers. For buyers, price opens below and closes above. So that is the information for this. But for line charts, it does not. It only ignores the high low the high low price information. Yeah, the high low price information, and it dictates the body of the candlestick in relative to where it closes. Relative to where it closes. That is for line charts. So it's really placed much significance on the body of the candlestick than the wick. Which is why I said, high and low is no longer relevant in determining the the significance of price information. It's no longer relevant because it represents price manipulation. It represents price rejection. It represents a no activity in the market, while the body represents the actual volume that takes place in the market. So we go to the next, having gathered information. Now, how does price move? You must understand the mechanism, the dynamism of price action along this demand and supply paths. You must understand the dynamics of price action along this chart. So with that, we say if there are two things, if this is a buy, let me take it just. So if this is a bearish, we call this is bearish candle. This bearish candle represents selling markets. This is bearish candle. Why this is bullish market. This represents the buying market. This represent the buying market. The buying market. So what happens is how you see how price moves. So you must be able to note this. So price opens for oh, sorry, let me do the mistake there. Okay, not a mistake. the high of the, that is the high, and this is the low. The lower wick is the low, the lower shadow, or the lower shadow is the low. Let me even put it in the inside the chart. The high, the low, bullish market. So you must understand the language of the price action. Yeah. So you are not blind spotted about the conventional way of interpreting the price action. We're not shown this. We passed this thing. When we're coming up, we're not showing this when we're coming up. So, and we have the open. This is the open here. This is the open here. It opens below, close above. Then we have the close. Closes here. By this one closes here. So if this is your bullish candle, right? Now, if price is going to go up, if price is going to go up, that means if price is going to open below and closes higher, right? The very first information you need to get is, where does it go first? Where does it go first? The very first, that's the very first information you must get, so that you'll be able to, because you must be able to follow the trend. The trend, you must be able to follow it, because the market makers are the trend. They are trend followers. You must follow the same way. So they make the trend. You must follow them. You must follow them. So if market opens here, market for bullish, this is market opens here, right? Market opens here. It must first go down to trail all the previous liquidity pools below the previous day low. It will trade them off. That's the support. Below the support level, it will take the liquidity below the support level, we trade them off, because that is what the market maker is all about doing in the market. They trade off the liquidity above the resistance and below the support levels. So they trade them off. That's their business in the market. So you must be able to understand where they operate. So the price must open here, right? It must first come down to create the low of the market, the low of the session. it will come down to create the left of the session, then try to move higher. Try to move higher to create the high of that particular session. After creating the highs, it will come down. It will, after taking the highs and takes off the liquidity above the resistance, past resistance, it will come down to what? To close below. To close below. So that is the information. Price will never move. Once it opens, it will never move higher immediately. Initially, it will never move up. It will never move up immediately. It must come down first before going up to close. It must first trade out the liquidity below the previous session support level, then trade it off, then go into the opposite direction. So that means when price open, it must first go in one way, then finally it will go in the opposite direction. So you can use this information to your own advantage. So that's for bullish market. For bearish market, for this price to close below, to open higher and close below, that means it must first of all trade up the liquidity that exists above the resistance. So that makes it to go high. To go high, to create the high of the session, then come down to the low to take out the liquidity of support level, then close here lower. It will close lower. So that's the behavior, the behavioral pattern of the market makers. That's how they operate. That's how they operate. You must follow them. You must understand the trend they create and move along with them in that way. You must understand the trend they make in the market up and down, and trade along with them. If you trade, you can't trade against them, or you'll be in a loss. Yeah, but they control the market, they control the volumes. So it is where the volume trends that the market direction will follow. So where the volume lies, the direction will follow. It determines the direction of the market. The volume that determines the direction of the market. Yeah, and who was the volume? The market makers. This is the major players, the interbanks and central banks and of this world, the hedge fund managers of this world. That is the basic knowledge of financial market. Yeah, that's right. So that means if you open up our chart now to see that information, here, we open up our charts to see this information here. You can see this is bearish. This is the bullish candlestick representing the number of buyers in the market. So that means price opened here, went lower, then it's now started moving higher, then close here. So close here. That's for buy. Now for selling, this is a candle for selling, right? Price opens here. It must first trade the previous resistance, then goes before it will now start moving lower to create the low of the day of the session, then close below it. So that means for the high to be created, it must first of all create the low. For the low to be created, it must first of all go and make up the high. So that is how the market trend. So that means if price is going to move downward like this, downward like this, is in a zigzag form, in a bearish market, that means it must first do what? It must first go up, then start coming down. The next candlestick will go up, the next session will go up and start coming down. In the next session, it will go up and come down. It will go up and come down. So that's what creates this zigzag in the market. This zigzag, this pullback and expansion. That will create that pullback and expansion in the market. So that is for HLSC. That is the formation for so if it is to go up, it will first come down, trail a support level of, then move higher to close higher, then come down again the next session, move higher, come down, move higher, come down, move higher. That's for bullish market. I hope you are getting clearer and clearer with that knowledge. So now, bringing this candlestick together, bringing this candlestick together, we have this, right? It gives us this combination of candlestick. Give us this combination. Yeah. Focus here. So you can see now this is how, when we combine this together, you know, when the price was moving down, right, to create a low, it opens here. So this place become what we call the support level of the market. This place here, from this open up to the high, this is the low of the market, right? That was the conventional way of saying this is the support. But coming to the new knowledge of this SNR, we come to understand that the real support is where the market opens here and starts moving higher to close here at this level. At the level of this close is what we mean by resistance. Market has created resistance. As it closes higher, that means it could not move. This is the level the market could not move beyond. It is the level the market could not move beyond, and not this the actual this thing here. So the significance is in the close level here, right? Then price will now open the second day. Price will open the second day, or the next session, it opens here and move higher, then downward. So this place now become what we call the resistance level. This is now the resistance level. This is now the resistance level. The resistance level. The resistance level. Why this is the what? This is the support level, where the market opens and closes the support level. Support level. Close the high. This is a bearish candle. So they come together to form what we call the support and resistance. The support and resistance. If you take note of that information, we're going to make use of this information in our next episode. Yeah, we're going to make use of this information. So this place becomes the resistance, and here becomes the support level of the market. So it now creates a boundary, two boundaries. We have that two boundaries. So when price close here, anything from here above represents the buying market. But anything from this place coming down to take out this place, the support level represents the selling market. Represent the selling market. To get that information now. I hope you've come to the understanding of support and resistance level now. So we have used this candlestick to explain what we mean by support and resistance level. What we mean by support and resistance level. Then price rejection. When we talk about price rejection is all about it's all about if this is the support level, that's the floor of the market or the bottom of the market, and this is the upper boundary, right? This is the resistance. The resistance. If this is resistance, then this is the support. This is support. So price rejection is simply when price is coming down. It's coming down. Oh, sorry. From the resistance level. From the resistance level, it's coming down, coming down, coming down. Then towards as it hits this support level, it bounces. It bounces. It bounces. So this particular place where it bounces off this level, this is what we call the price rejection. Price, that means price rejects, sellers reject they reject the what? They reject the lower price, rejecting the lower price. So they've come here, the sellers have come to the bottom of the market and buy at a low price. The philosophy of the market is to do what? For you to be in a consistent profit, you must buy low and sell high. That is the philosophy of the transaction in this market. You must buy low and sell high. You buy low at a lower price, you sell at a higher price, right? So once the seller gets to the support of the market, they've taken their market from the previous support. This is here, taking the market from the previous support, and they now start going higher to distribute profits. For buyers, they are going to sell at the higher price, right? So they start moving up, moving up, moving up, moving up, moving up to this level of resistance. So when they get higher here, they face it when they sell off. When they sell off at the higher price, price will start coming down because they are coming down to buy at the lower price in order to sell again at the higher price. So this place become a resistance for buyers. Why did they become a support for sellers? Yeah, become a support for sellers. So that is information about price rejection. We call this price rejection. Price rejection. It comes down and price got rejected at the support. So that means sellers rejecting the lower price and buyers rejecting a higher price. So the objective of, you must understand the objective of the two players now. The objective of buyer is to do what? Is to negotiate, is to bid for a lower price. Is to bid for a lower price. As far as they can, as far as any level they can go, they're going to move lower to bid for a lower price in order to make more profits by the time they start going higher. So the objective of seller is to do what? Is to sell at the higher prices. Sell at the higher prices. So they are facing resistance from the sellers are facing resistance from the buyers, while the buyers are facing resistance from the seller. Then what you buy, well, I'll show you. I've talked about the price manipulation here. What the price manipulation is simply about trading off the the low, trading in the opposite of the retrail stop loss. Like this man said here, the Wyckoff, that liquidity will always exist, and therefore so will manipulation, according to Richard, one of the legendary traders. That all the fluctuations that I've shown you in the market and in all the various stuff should be studied as if they were the result of one mass operation, the market players. So it is called a composite man who in theory sits behind the skins and manipulates the stocks to your disadvantage if you do not understand the game as he plays it, and to your great profit if you understand it. Yeah, so if you understand the game of manipulation, you will profit from it. If you don't understand, you are the liquidity that they want to take off the market. Yeah, so if you understand the market, that means you are making profit. But if you don't understand it, you are the liquidity that the market is looking for. The liquidity the market is looking for. So let's go straight back to that. So manipulation is all about taking off the support level and the resistance level. Taking off the support level where price come to this place. This is a resistance level, right? When price come to this place, what happens? It will trade off all the available stop losses above this place. Then it will start coming down. We told you from the candlestick that for the price to come down, it must first go up. So that going up is a way of what we call the stop hunting process. So they use it to trade off all the people that put their stop losses above this resistance, resistance level, then start going to distribute in the opposite side. Then they trade off the support level. So they hunt the support and the resistance level. They hunt them off. So that is all about what the Richard Wyckoff is trying to talk about. So that is, we come to the end of module 1 with that explanation. Like for here now, if you want to understand please get to understand this thing very well, because we are going to make use of it. So price will go here. This is resistance. It will trade off this resistance and withdraws back. When it withdraws back, it will now start moving to distribute profit. Once you get to the support level that's broken through it with a wick, it will withdraw back. So they use the wick of the candlestick to manipulate the market. So you must understand that. So that means for here now, this is the resistance level. If this is the resistance level of the market, so price has moved move out the whole stop loss available above this resistance level, then they will start coming down to not trade off this level of support. Will be traded off. So for support level, what price does is to take off the support by using the wick. This is the wick. By using this wick, trade off the support level, then it will start going to the opposite for the distribution of profit. So you must understand that. So through that, we come to the end of this. So we want to, for the cap, we'll be able to understand the price information, how candlestick is being formed, then the difference between the candlestick and the line chart. We'll be able to understand how price move along the supply and demand curve. So then finally we come to the knowledge of price rejection and manipulation, which by next we will talk about the we come fully into the SNR.